Figure like it.
Oh, this is fun. It's a farm. It's gonna be a school team, so I mean,
So these are what
so I have a multitude of spoken names.
Oh, okay. Little, kind of budget to do.
Okay. Yeah.
Calendars.
Okay.
True.
Well, you know, nobody's on the mic, but I can hear the ambient noise in the room, so I think it's okay.
Testing 1, 2.
That sounds good.
6:30. Oh, you have to sit down on me. Oh, please do, yeah. Okay, now we can start.
Good evening. I'm Kip Attlee. I'm with the Calvert Concept and also known as C4. It's for housing and reconciliation. And I would encourage you to let people you know who might benefit from it know about C4. We help people move from financial fragility, if you will, kind of iffiness, through to financial empowerment and generational wealth, the experts call it these days. And the idea, we help people deal with financial issues that they have, correct them, start savings effectively, investing as appropriate, and moving on through towards home ownership or business ownership. We've got 3 categories of folks we focus on. One are public servants, for instance, county employees and that sort of thing. Folks who work here, help us all, but can't afford to live here. The other is people who are descendants of enslaved people in Calvert County's history. And what we've learned is a lot of people coming from that background still have significant impediments, aren't their fault. And the third category is, you may know some folks in this, people whose children have kind of fallen out, often due to drugs. They end up raising their grandchildren, using up their retirement resources, raising their grandkids, and that wasn't part of the plan. So those are the 3 groups we focus on, and we're pleased to partner with the Commission for Women in this series, along with the library and in other endeavors. But Brandy, thank you very much for doing the presentation tonight and being responsible for so many of the presentations.
My pleasure. So I'm Brandy. I am with the Calvert County Commission for Women. We do a lot of things for the county, including this literacy event along with C4 and the library. It's a monthly event. The next one is on the screen. It is financial aid fundamentals. So I'm really excited with my 4 children because we're gonna need some help. So that'll be next month. We also have a clothes closet where we give professional clothes for free to any woman in the county who needs it. So those are all on our website, as well as supporting any of the needs for women and girls of Calvert County. Isabella, do we have people online? I just want to make sure I'm thoughtful. Okay. So if you have questions during it, I might just repeat back your questions so the people online can hear. So. All right. So just to let you know, I do have advanced degrees in economics and finance, but I am not licensed. So this is for educational purposes only. Personal finance is a really important topic for me. I did not start having any generational wealth, so I had to build it from the ground up, and I think that has taught me a lot. So these are just some disclosures, just saying, please don't come after me. I have all everything in here is not original. It is, I have researched, and I'm just repeating what other really smart people are saying. So there we go. So Warren Buffett, who is a billionaire and has been known as one of the best investors of our time, says, do not save what is left after spending, but spend what is left after saving. Some other investors have said to pay yourself first and then spend what's left. I know that can be really challenging when you're feeling like what's left. When you do your budgeting, but that is the whole idea is, we've definitely heard to build your life around living beneath your means. So we'll talk more about that here. So why invest? People online, folks in the crowd, why, like, what are your goals? Why are you here? What are you excited for? Is there like a house down payment or people that that are like, why would you invest? You just shout it out. Yes, ma'am.
One buried there, so they would spend it, so they wouldn't waste it. The other invested. Well, and the person that buried it has got ridicule, and I was like, I don't get that. They were trying to protect it, so. The whole purpose of the story was to put the public, make more with that, and that is not naturally my mindset. So I want to know what do you building to increase what I have.
Right. Okay. Absolutely. So how to build on more? It's fantastic. We have so much, but if there is a vehicle that we can park something in that's going to give us back more, and we're still doing the same thing as we would have, burying it at the ground or putting it into a certain bank account, why not? And I feel like there's been a barrier, kind of what Kip was alluding to. Growing up, I felt like there was a gatekeeper for some of this information. And now, with technology and everything, we have access. This investing is for everyone. So does anybody else have a goal or a reason that they're here? It's okay.
Brought up daily things that we go before your budget, but not looking at the broad picture.
Yeah.
So when I went in, something that was said, the professor, I was like, see now, it says, hey, how many of you pay this off? Well, some is mortgage, pay market, $3, and he says, I did not invest in that. How many of you pay your stuff?
Mm-hmm.
At the end of well, they are mortgage, they are, that's not paying.
Right. Investing in, yeah, right.
No wonder we felt every single month that Warren computer can't fall. And for me, it's to get in that moment where I can lay down what little house I've got, what it looks like, however it's decorated, and I can feel, oh my God, I don't have to worry about having to. I mean, I do have to, but you don't have to be, you're constantly in and out.
Right. We're not trying to own yachts. We are trying to just have some freedom, right? Some flexibility to be able. I saw something the other day that I just want to be able to, if the kid's on the street selling some candy bars, I want to go buy his whole box so he can go home early. Like, I want that kind of flexibility. I don't have to go around the world 3 times, but I absolutely hear you. So some of the other reasons people say is rather than burying it in a hole, and then you go to dig up that hole, you're like, I remember this being bigger, this thing underground, and this won't buy the same thing as when I buried it, right? Because of inflation. So we invest because that little bit of percentage we're hoping will help keep up with inflation. So even though you're still buying the same thing you did 5 years ago, you'd be buying less if you weren't able to beat inflation. We want to invest to achieve our financial goals like retirement or a house down payment or an education. I've got kids who are 11, 13, and 16, 4 of them. And like we need to invest because there's no possible way for me to save enough money by putting it in the savings account with no, I need to build that interest that needs to be able to grow for financial security, like we were saying. And it would be nice to have some passive income. So not every single thing we're doing, we have to make our, it's not by the hour, but it's rather the money's working for us. Before we even get to investing, though, I think it's super important. Sometimes people talk about investing and then they're borrowing money. Those huge hedge funds and things like that, they might do that, but we got to make sure that certain things are taken care of before we start. And that's one is paying down our high interest debt, right? So it'd be great. So I have $1,000 and I'm like, I'm going to go and put that into an account that makes 4%. And at the end of my year, I'm going to have $1,040. Awesome. But at the same time, I only paid the minimum on my credit cards, which were at 25%, and I just gave them $2,500, right? I think we know. So we're going to pay down our high interest debt, which is any debt that has an interest rate that's higher than what you'd be earning from your investments. So yes, we want to, and sometimes people, it's psychological. So they want to start that habit. And I totally understand that. Yeah, start the habit, but really focus on those high interest, that high interest debt first. Before we invest and we're taking that money, we want to build an emergency fund. Kind of going back to those credit cards, so we don't put more money on our credit cards when our hot water heater goes down, when something happens with the car. And I have here over to the right, some of these things, these life surprises that happen, like, all of a sudden we lose our jobs because they decide to cut all the federal workers, or medical expenses, home repairs, a death in the family, you need to fly across the country, right? And you weren't planning for those things. So building that emergency fund, money, setting that aside and not touching it. And we were talking before this all started about where to park things like that, something that you are not going to try to touch, but you need it there if you need it quick, and something like a high yield savings account. And I'll go into that in a second. And before you invest, let's have a budget. Let's find out what do we have that's extra? How much can we pay ourselves? So you're going through the math and you're saying, all right, if all my needs are met and I've done my budget and I see I can put away $300 a month. And I know if I don't pay myself first, where that money's going. It's going to go to Panera, like I just went, or it's going to go somewhere else. So if I want to see at the end of the month that my bank account it's like that doesn't even exist, that extra $300. So we want to have a budget, and I will share this presentation. So there's some templates out there. It's very personal, like how you want to budget. I use an old spreadsheet. Some people like paper and pen. Are there any questions about this before we, and just shout it out. So just really briefly, the difference between saving and investing. When we want to save something, or if we're buying something in 0 to 3 or 4 years, we're saving. We're putting it in something that we can get the money out quicker because it's a lower risk, right? So for a car or a vacation, somewhere that's going to keep your money safe, somewhere that's FDIC insured, usually it's up to $250,000. So that means that if all of a sudden the bank crashes, the government's going to come in and they're going to insure your money up to that amount, right? And then for investing, we're talking long-term goals, because we know, I think all of us were around in 2008 when the market dropped, and then since then it's skyrocketed up. So if you kept your money in there, you would have made, if you put your money in 2006 and then you saw it drop like that, and then but you left it in there, you would be doing really, really well now in 2025. So this is long-term goals. Of course, there's higher financial risk. So for things like your retirement, I think a lot of you probably have, if you have a retirement account of 401k, you have it in things like stocks, because it multiplies your money. So whether you're going to put it, we're going to go into this in more depth, whether you go into saving or investing, a lot of it is like, how do you feel? So I might tell you, okay, you're 12 years out, stocks, that's the answer. But then you say to me, I can't sleep at night if I've got my stuff in stocks. I'm worried about the market. Well, that's important. So if someone tells you this is the answer, that's not right, because it also depends on how you feel. Your own behavior also matters too, right? And your financial status and what your goals are. Some people might say, I know I'm going to get a windfall. I'm going to get a huge inheritance at some point in 20 years from now. So I'm going to have a lot more taxes to pay. Okay, so you might want to figure out how your finances work. So you're not going to have a lot of taxes to pay back then. You might want to have more of your taxes taken out now. So yeah, it really depends on your financial goals and your situation. But let's just go through a few things. So this is, again, thinking about your goals. And I really recommend you just kind of like brain dump things out. Like, what am I looking for? Am I looking for a house down payment in 4 to 7 years? So like, let's just go. So next year's vacation, are we saving, investing, or doing both for that? You can just shout it out. Saving, right. Retirement, investing, unless you're somebody just like, I can't handle it. But I hate to break it to you. If you're putting your retirement in a savings account, you're going to be working for a really long time. Your house down payment, 4 to 7 years, you might do a little bit of both, right? You might have part of it in your savings account in case you find the house in 4 years, but then you might have some of it in an investment account because you think it might be longer than that. So again, it depends on your own, how you feel. All right, so common savings accounts before we even get to our investing, we have the traditional savings account. This is we all kind of probably have this. Our checking account is usually linked to it, easy to open, crazy low interest rate. So just some quick math on that. 1 year return at a 0.42%, and 0.42 I think is generous. I think mine's 0.1. You're going to make $4 that year if you put it $1,000 in that savings account. A money market, I don't know if people are really using money markets as much as anymore, but it's like a savings account, but usually there's checks tied to it. So usually gets a little bit more. So you're making $6 if you have a money market. Both safe, both insured. CD, again, depending on the term, you might have something you're like, I don't trust myself. I want this. I'm not, but I need it in 3 years, or I need it in 18 months or 6 months, depending on the term of the CD. So you're going to have a higher percentage rate, interest rate. So you're making a little bit more. That's something that's illiquid. So a liquid means that you can access it, and you can you can access it easily, right, and efficiently. So those are usually at online banks or brick and mortars. Now, the thing for like that I tend to like for myself is a high yield savings account. Anyone here have a high yield savings account? Okay, so right, good. So that is something that's going to have a higher interest rates, usually through an online bank. So you're not going to be able to go in. I actually am going to buy a truck. I'm really excited. 59 Ford. I've been dreaming of this truck for many years, and I'm actually going to buy it this week. But I have my money's sitting in a high yield savings account. I can't get to it. It's been a real pain to get that money out of the bank. So I have to transfer it to a checking account to access it. So it is liquid. It's not as easy to get as a traditional savings account, but I'm making 4%. So this year, if I had $1,000, I made $40. That's passive income. That's income I didn't have to work for to get that $40. So if you have something, your emergency fund should be in a high yield savings account. Why wouldn't you want to make $40 rather than $4? Right? It's safe. It's insured. Make sure everything is always FDIC insured. But any account that you might want to access in 0 to 3 years, I would park it in a high yield savings account. And you can usually get at least 6 times a month you can get your money. Depends on the bank. Okay, so this is just a slide, and you can take your time to look at it on your own about what your risk tolerance is. Usually the higher returns means higher risk. Safer investments like savings accounts are lower returns. So you can look through that on your own. I just wanted to put that out there. All right, so what is investing? Buying assets which you expect to increase in value over time. Very simple. So here are some of the more basic ones. We'll go a little bit more into depth in a few of them. Stocks are, you own a piece of that company, right? So if you own a stock in Apple, I might own 1/1,000,000th of Apple, right? And that's all it is. That price can fluctuate up and down. You buy it on a stock exchange, and we'll go into a little bit more about how you buy these things. A commodity, a raw material or basic good, you can buy this on a stock exchange, or you can get into commodities. I am not, but corn, wheat, cattle, crude oil, natural gas, sugar, coffee, all of these things that can be interchangeable because you're not buying one type of wheat. Wheat is just a price. They'll say like, oh, the price of crude oil is going up and down because all crude oil is essentially priced the same, right? We can invest in real estate. Generally, your primary home, people say that's not an investment. It is something that you expect to increase in value over time. But going back again to 2009, we know that's not always the case, right? Or 2008, sometimes the prices do go down, but we expect it generally to go up. Rental properties. Has anybody heard of house hacking? That's something that folks are doing, especially younger folks. They'll buy a house, like a duplex, let's say, and they'll live in one side and rent out the other, or they'll rent out one of the rooms, and that's a way that they're making money to pay their rent. Flipping houses, vacation rentals, REITs are something that are fairly new, real estate investment trusts. So basically, it's a company that has like a portfolio of real estate, and you can buy, just like a stock, you can buy a piece of it. So you have a share of that portfolio. And you can get those in ETFs. We'll go into what that means too, but it's like a stock that you buy on the stock exchange, which is a piece of that portfolio. And then of course, bonds, where you're financing the debt of a borrower. So we're financing the debt of the federal government. So we can buy a treasury, and it's a fixed interest rate. So you say, I'm going to buy this bond, you're going to give me a coupon that is 4% interest for the next 20 years. And eventually you're going to get back your principal that you loaned to them by a particular date. Or you can also debt finance companies or municipalities. You know, we all hear about bonds that are coming up for the different counties or municipalities. All right, so the different risks, and sorry I'm going through this quickly, I want to make sure I have time, but definitely feel free to interrupt at any time. So we have lower risk and higher risk, and this goes again to your risk tolerance. Cash, lowest risk, but obviously lowest payout. We're losing money every second we have cash in our pockets. Generally, bonds are safer, especially treasury bonds, and you can buy those online. I think I have a link to a website in here where you can go on to the U.S. Treasury website and buy their different bonds. Mutual funds, ETFs, those are generally less riskier than stocks because it's generally an index or big group of stocks. And we'll talk about that in a second. Right. And I'm gonna talk about that in just a second. So I know that's one of the things that's like, what? All right. So again, a stock is you own part of that company. You actually have voting rights to that company. So if I own a piece of Apple, which I don't like to own one company because I'm putting all my eggs in that basket. I don't know, like I know we can read about what Apple is saying that they're doing with their company or Walmart, but I don't read everything I'm supposed to. So to say that I'm in their heads, I'm just trusting that it's going to go up in value. But what if I find out actually their new CEO is a total jerk and doesn't know what they're doing, you know, or what have you. So I don't like to just buy one company. I like to buy a mix. That's what we say, don't put all your eggs in one basket, right? But again, that's just me. So usually we have a higher risk, again, because these stocks can go up and down. We've seen the stock market crash and go up, 30% in the last few years. And then what you earn is through gains. So when the price goes up, and you earn through dividends. So if you were to sell that stock, and it made money, you have a capital gain, right? If you sell it and you have the stock price has gone down, you have a loss. You also, a dividend is that company has made a profit, and so they give that profit back to their shareholders in the case of a dividend. So bonds, again, we were talking about loans to governments or companies, generally lower risk. You know what they're giving you is this coupon, and you earn interest. Sometimes, have you ever heard of junk bonds? Because they're saying, well, what if that company goes out of business and they can't pay their debts, which is their debts are to you. So there is a chance that you could not get that payment. So, but we're generally not going to lend money or buy junk bonds. Okay. So mutual funds and exchange and ETFs, exchange traded funds. They're both of the same thing. So mutual funds have been around longer. So it's a pool of investments managed by professionals. And it's a mix of assets like stocks and bonds. So if you have a fund like a 2050 fund or 2045 fund, so it's the year you think you're going to retire, in there, the closer you get to retirement, the less risky the assets are going to be in that class. So you will have, so if I knew I was going to retire in 2070, I guess my kids might, or 2060, they're going to have a ton of stocks in there because they just want growth. They want it aggressive and they have plenty of time for that stock market to go up and down. They're going to have very few bonds because they've got a huge time horizon. But if I'm going to retire in the next 5 years, well, whatever I've made up to that point in one of those funds, they're going to make it primarily bond related because it's less risky. So that's one way that you can do it is a dated fund like that. But then other mutual funds with the pooled investments, you could have something that tracks the S&P 500, which is the largest 500 companies on the stock market. So what that will do is you buy a share of all those companies. So you're buying like 0.001% of Apple, 0.001% of Microsoft. And it's probably way smaller than that too, but you get my drift. So you're getting a little bit of all the companies. And why people generally like that is they're saying, these are the biggest 500 companies, or there's even one called VT Sachs, and that's all the entire stock market. It's called Total Stock Market Fund. And it's by Vanguard, and it tracks all the companies. So if the stock market crashes, yes, you will lose money, but that means things are really bad, right? For everybody. So it's okay. So what I like to do for me is to buy a fund that's got a little bit of everything. Some people, they're like, okay, I know a lot about oil. So I'm going to put a lot of my money in oil because I know that I'm going to hear something on the news and that's going to make me know I need to sell oil. I don't know those things. I just want to live my life. I want to make my money at work, put it into my investments, and I'm going to put it into what's safe. And that's generally an index fund. Again, that's what we were talking about, an index fund. Generally, mutual funds are index funds too, but they don't have to be. And an index is a little bit of all the companies. So when you hear someone talking about that, that's what they're saying, is like little pieces of different things. And you can have mutual funds about anything, mutual funds about robotics. You can have mutual funds about AI, and they're all just invested in companies that are related to that. So if you're like, I think that water, we're going to really suffer in 15 years. There's going to be a lack of water. I'm going to invest in a mutual fund or an ETF that's related to water. They're out there. I'm telling you, everything is out there. There is one for everything, a little pool of stocks, because you're like, I don't want to just buy one stock related to AI. I want to, because I don't know if AI is going to do well or which company is going to do well. So I'm just going to buy a little bit of all of them. ETFs are a little different because they're traded like stocks. Mutual funds are traded at the end of the day. So you're pooling your money, and at the end of a trade day, the professionals take that money and then they invest it. Where an ETF is that index fund, but you can trade it at any point. That's all it is. It's just easier to trade. So some people say, well, why do you want to do a mutual fund? It's just preference. But the ETFs, again, are traded constantly, and anybody can do it. And we can talk about that. Now, if you look on the screen, just to kind of go through like what a stock. So here we have a fund name. This one's Fidelity 500. So it's going to treat it like the S&P 500. It's tracking the top 500 companies, the biggest ones. Here are just some examples of what might be in this Fidelity 500 account. And you'll say, well, what is this 7% next to Microsoft? So even though it has 500 companies, they're not all equally weighted in this particular stock. So in this particular mutual fund or ETF, this one's a mutual fund. The professional that put it together decided, I'm going to weight Microsoft a little bit more than all of the others. So the 500th company probably is like 0.0001% of the mutual fund. So generally, when you have a fund like this, the bigger companies are weighted more, just FYI. There's the ticker symbol. So if you were to go buy it at Fidelity or Vanguard or some of these larger brokerages, that would be the ticker symbol. Now the expense ratio, this is where I really wanted to point this out. We don't have to worry about the NAV. So the expense ratio is how much you're paying the mutual fund or the ETF to do this service for you, which is to gather up all these companies. So you're only paying 0.015%. It used to be we have to pay a commission, $5 every time we wanted to trade. It should be free now. Every time you're trading, you shouldn't be paying any money to trade a stock. But you are going to pay an expense ratio if you're using a mutual fund or an ETF. You want that expense ratio to be really low. Now, it's really important when you go, like if you go look at your 401k after, this is why, we were kind of talking about this earlier. If you're looking at whatever you're saying, I didn't choose the stocks that are in my 401k, and somebody else did it, they're doing fairly well. Look and say, what is that expense ratio? If you're seeing anything that's 1% more, it's time to stop and like start asking some questions. Because what are they really doing? Why couldn't you just have gotten the Fidelity 500? You're like, oh, well, I made 10% last year. Well, somebody else might have just had an S&P 500 and also made that same percentage, but didn't have to pay their company 1%. They had to pay them 0.015%. So expense ratio is really important. Yes, ma'am. So, yeah, so yes. Restating. Okay. Oh, so about any question or? Oh, okay. Absolutely. So the question was, what is the expense ratio of? It's usually the cost of the stock. So if it costs, so if you bought, so the NAV is how much you paid for that stock, $177.94. They're going to charge you 0.015% of that. Right. Yeah, off of that price, how much you bought it for. So if you bought 500, because now you don't have to just buy a whole stock. You might buy $500. You can get fractional shares now. So you might put that in. And so you're paying 0.015%. It's kind of like a commission, but it's an expense ratio. So it's a cost that you're paying. So especially nowadays, you're not paying a hedge fund to go out and scout a company for you. This is just a group. They went to the grocery store and you told them to pick them one of everything. You don't need to pay the Uber Eats 1% when you know you can pay Grubhub 0.015. They're doing the same job, right? So a lot of times you'll see those target date funds, that 2045 fund, they'll have a higher expense ratio. Just shop around. And we'll get to it a little bit more in a second, but a lot of times 401ks don't give you the flexibility that an IRA would. Our IRA, you can go onto the market and you can kind of choose your investments. A 401k might say, these are the 4 that you can get. So you might be limited there. This is just something for your own reference about risk and return and liquidity. Certain things have more liquidity than others and a higher return generally, like we were saying, riskier, the higher the return. So I just threw this in there for your own reference. So our types of investment accounts. We have our retirement accounts, and then so those are generally tax advantaged on the right, where you can buy investments for the purpose of saving for retirement, right? 401k, 403b, 403b, an IRA. So the retail brokerage accounts, meaning, okay, I put money into my retirement account, that's separate, but I also want to buy stocks on my own without going through my my work, or it's something maybe I want to invest in for 10 years because I want to buy a house in 10 years. I want my own account. So those are the platforms that you can use, like Robinhood, Fidelity, Vanguard. Does anybody have their own brokerage account that's separate from retirement here? Okay, May does. Right. So, and you can do the same thing. So you you go on to Fidelity. Let's just say you create your account. You say you want to fund it. And then you say, I want to buy, I'm going to make up, I want to buy Apple, or I want to buy the S&P 500 stock. Of course, do your research. What sometimes people do with some of these accounts is they fund it and they go, great, I invested. And then they don't actually buy anything. And then they go back in 5 years and it's still the same amount that they put in because they never actually bought anything with it. I heard, you would not believe how many people do it. It's really sad. And people do it with their retirement accounts. I have a really sad story that I heard. A woman with her 401k, I don't remember if it was a 401k or a Roth, but she was funding it every year towards retirement. She never actually bought any stocks with it. So she was just putting that money in every month and then never took and bought a stock with it. So it was just sitting there for all those years. So when she went to take it out, she thought it was going to have grown and it never grew because it was just in a settlement account. She never bought an index fund. She never bought Apple. I mean, it's really sad that, she didn't have statements to look at. I don't know, but that just broke my heart. And it's very, very common to just, so you want to make sure it's invested in something. All right. So our different retirement accounts, and this I know I think it can be confusing. I don't know. It was for me the first time I saw it. So we have a couple of types. We have our IRA and then a 401k or 403b. These are just two examples. There are many more types depending on where you work generally too. You can have more than just the 401k or the 403b. So your IRA, individual retirement account, you can go to a bank or online. As long as you're making income, you can get an IRA. Now there is a type of IRA. When I was a stay-at-home mom, I could get an IRA because my spouse was working and I was a stay-at-home mom. So there is one that you can do for that. So if you know of any spouse that's staying at home to take care of the kids, encourage them, even if it's just a little bit, they can do that because their spouse is working, right? Just because they're not getting paid doesn't mean they're not working, and they shouldn't be working towards their retirement, especially women. We need to be building our income because we generally are the ones who often take off time to stay at home. That can be in traditional or Roth dollars, and we can talk about that in a second too. And usually it has a wider variety of investments that you can put in there. It's usually the entire stock market that you can buy from in these IRAs. The max that you can put in is $7,000 for 2025. It didn't go up this year. If you're 50 or older, you can put a max of $8,000 into your IRA. Now, yes, Kip. That's my next slide. Very good. I'll talk about that on the next slide. I just want to get through these. Yeah, I'm just going to get us started. And then a 401k, that's only through your employer-sponsored plan. Can't have a 401k unless your work offers it. The employer can contribute. If your employer matches, that's free money. Make sure you're taking advantage of that. If they're saying, we'll give you, for every dollar you put in, we'll match it up to this X amount or percentage, that's one of the first places you want to be investing, because otherwise you're leaving money on the table. Right? Does that make sense? Okay. But generally, like we were saying, there's limited investment options to what, you can't buy the whole stock market generally, or certain funding, target date funds and everything. So oftentimes there'll be higher expense ratios in there. And for 2025, it's $23,500 you can contribute, and $31,000 if you're 50 or older. You can have both of these accounts. So you can contribute the max on both of those, or half, or and you can have a Roth in both of those, and we're going to talk about that next. You can, yes, CAN, sorry. Okay, so let's talk about our different contributions. And again, these contributions can be into either of these. So a traditional contribution, pre-tax, right? So it's in my gross before it hits how much tax I owe. This is a traditional contribution. It reduces in the year that you made it, and the investment accrues money, but that tax is going to be deferred until you withdraw it, right? So again, like we were saying, it really depends. When do you want the tax to hit you? These years or future years? And that kind of matters where, traditional and Roth is something to consider. And it's generally taxed as ordinary income and when it's withdrawn. Your Roth contribution is post-tax dollars that you contribute. So whatever comes into my paycheck, I put that in, and that I pay my tax when I put it into my Roth IRA or 401k. And when I withdraw it, it's taxed. Everything that's accrued, all of that is not taxed. So generally people enjoy that because then their money has grown and they don't have to pay taxes on it. But again, it doesn't reduce your taxable income in the year that you contributed. Yeah. So if you have an IRA, so the question was, what is considered a Roth contribution versus traditional? So you can have a Roth IRA. So that means you put your money in that's after the taxes have already come out of it, right? So that's your Roth. You can also have a traditional IRA. So it's pre-taxed, and you can have a 401k that's a Roth. So it gets, if your employer provides that for you, so you can put your money in post-tax, or you can have a traditional 401k. So it's pre-tax. You choose. For the IRA, you choose whatever you want, but for the 401k, it's what your employer offers. Sometimes they don't offer a Roth. Hi, you're welcome to come in. Okay. Well, yeah, she's been wild, so. Yeah. Right. Right. Yeah. You, if you're 50 or older, you can do 8,000. So you get, but for your. Right. So for traditional, you're able to put in 1,000 more for a catch up. So, right. Did that make sense for the traditional and Roth, or? You can have both. Yeah, I have both. And also, even if some people who might be online or in the room have their own business, so you can have what's called a solo 401k. So even if you're a sole proprietor, you can have your own 401k. And same thing apply. You can do a Roth or a traditional. And what's really cool about those, this is a little side note, is you're the employer, but you're also the employee. So you can put it in a maximum of, I think it's like 60,000 a year. Obviously it can only be, I think it's like 25% of what you make. But so you can contribute to yourself as your employer, and then you can contribute to yourself as your employee. That's if you work for yourself. Mm-hmm. If you're a business owner, you can there's a few different types of 401k accounts that you can do. One in particular is a solo 401k. So that's an employer sponsored, but you are your own employer. So that means that you can contribute as your employer up to a certain amount. And I think I forget the dollar amount, but it can only be up to 25% of what you made. And then as an employee, like we were saying before, you can do up to 23,500. So and that sometimes people have their own business accounts and they make money and it helps fund their retirement. Yeah, so I think there's SEP is the other one, SEP, and they all have different requirements and rules. Okay, and then our 529 accounts for education expenses, you can have it for yourself, you can have it for your children, your grandchildren. They don't have to know that it's there, and you can have one for them. There's no limits for how much you're putting into it. You can use that for private school. You can use it for college. It is tax-free investment growth and tax-free withdrawals for qualified expenses, books, a variety of things that will count when you go to withdraw it. In Maryland, I forgot my parenthesis there. Maryland has a tax deduction for your state taxes if you're contributing for a 529. So if you want to start a 529, you go to the state or you go to a brokerage and you were to open one there. But yeah, you always want to look to see, does my state offer any kind of incentive for having one? When I lived, we're a military family. So when I lived in Alaska, if we opened one there, they gave all the kids an extra $100. So, and anybody can do that. Anyone in here can open one in Alaska. I think there's a small limit to what you can contribute. So we moved here. I found out about that. And I opened another one for them in Alaska because I wanted that $100, per kid. That's a book, I think. Who knows if it'll be a book in 10 years, but it's a book today, I think. So again, the flexibility is amazing. You can transfer it from kid to kid. You can transfer it to grandkids. They can transfer it back to you. This I don't know a ton about, but it is a fact that $35,000 can roll into a Roth IRA for the child. I don't know what the conditions are, but that's something I'm definitely going to look more into. And yeah, like we said, the beneficiary can change, and there's various types of 529s. But some people worry, well, what if my kid doesn't go to any kind of school after this? This has to be just used for education. So that is something to consider. Health savings accounts, if you have a high deductible insurance plan, these are amazing because of the tax benefit. They're triple tax advantage. So it's pre-tax contribution. So you're lowering your taxable income, tax-free growth. And when you withdraw it, it's tax-free. So if you have access to that HSA, it's great to use it. And here's the thing. It's not like with the government, like we have flexible savings accounts, FSAs, where you contribute up to a certain amount each year. And if you don't use it, you lose it. That's not true with the HSAs. You can keep those in there for 30 years and it can continue to grow tax-free. And then, because I'm thinking, okay, in my 80s, I'm going to need a lot of health savings account money that I'm going to get. So that's been growing for me. So if I need care, then that's what I'm going to use it for. But it can also be used for, braces and things like that as they come up. This isn't on here, and that's more of a savings account, but the flexible savings account is also a good way to have a savings account, right? So if you have, I have 4 kids who needs braces. So every year I do that pre-tax. The flexible spending account is pre-tax money. So I feel like I get like a coupon for 20% off because it's 20% or 25% that's not taxed for me. Yeah, so it can be invested kind of like a retirement account after reaching a certain threshold. And yeah, but you do need to have a high deductible health plan to get access to the HSA. So in the military, we do not have this. In the federal government, we do not have this. All right, just some common mistakes that folks make when they want to think about investing and buying stocks is trying to time the market. Like, I'm going to wait to buy until it bottoms out. it might not. Or I'm going to sell because I think it's the top of the market. How do you know? Like timing the market it's better to have time in the market than timing the market, right? Just wait longer term. Investing without an emergency fund, ignoring those fees like we were talking about, letting emotions drive decisions, watching the news and being like, everything, the sky is falling, I need to get out of here, and selling things and losing money. It's better to, my opinion, for my investments, to set it and forget it. Look away. You know, if you have a long-term plan, if you're talking long-term, not letting your emotions drive those decisions. Just like when I'm hungry, I shouldn't go into Costco like I did last week. And not having a goal or timeline and investing maybe in the wrong product because you're thinking that you're going to park your retirement in a savings account, or you're putting the money that you need for your vacation into stocks. And notice we didn't talk about crypto or anything like that today. We're not talking about so yeah, we're talking about things that we assume are going to make money over time. And putting money into an investment account and not buying anything. That's a really, that's something I've said before, and I'll keep saying again, just make sure you have invested that and ask questions and call your brokerage, call your retirement account advisor if you have one at work, and ask them, did I do this right? Be humble, ask questions. And of course, diversify. Don't put all your eggs in one basket. I'm not just going to buy Apple and Microsoft, and I'm not just going to buy Target and Walmart. It's like, I'm going to buy umbrellas and sunscreen, right? Because I don't know what things are going to be like tomorrow. So I'm going to buy both. Same thing is true. And we want to make sure we're building good habits. Creating and sticking to a budget, tracking our spending and staying on target is the first thing before we're doing any of the investments. Paying yourself first. So knowing your budget, putting that, saying, I can spare this extra, $50 a week or whatever, and paying yourself first. It will feel really uncomfortable when you start doing that, but over time, it'll get easier. Automate your contributions, have it automatically come out of your check, automatically come out of your bank account at the same time every month. Like, okay, the second half of the month, I have a little bit more wiggle room because I pay my rent or pay my mortgage the first of the month. Awesome. Automate that contribution like it's a bill. And, it's your mortgage, it's whatever, and have it automatically sweep into your retirement account. And have that retirement account automatically invest whatever you're sweeping in there. Okay, so automate everything. Reinvest those earnings. So there's a button that you can click when you're going in there that says, whatever I make, if they give me a dividend, I want that dividend to go in and buy more stocks. Usually they opt you into that, but just make sure that those earnings aren't going into an account that's not buying more stocks. You just want this to continue to grow, right? And review your portfolio annually. Generally, if you're buying an index fund or an ETF, a little bit of everything, and you're like, I'm just buying everything, I don't need to take a look. It's good to look at it occasionally, right? Maybe not every day, just because, you might freak out and you're like, I lost $1,000 in the last day, or $100,000 if you're close to retirement. That can really upset you and mess up your day. So not looking at it daily, not looking at it when somebody tweets something, and that turns the market upside down. Once a year, take a peek and say, what can I, how am I looking? Do I need to rebalance anything? And keep learning and asking questions for sure. And there, I just have some definitions for you. There's some things that people usually ask. Here, I will recommend my favorite book when you're kind of starting out, and it's a good read. It's called The Simple Path to Wealth. They generally have it at the library. And J.L. Collins, he just kind of repeats a lot of things I say here today. And then just some of the websites I like and some of the podcasts. So, and that is it. You have questions? Any question at all?
Yeah,
Yes, Kip.
no, last time I was aware of the conventional thinking on cycle of the stock market, generally 7 years. You want to stay invested at least through a 7-year cycle, and should be looking at, on average, that's going to occur, which tends to allay your concerns if you're there for long. Is that still conventional wisdom to be thinking in terms of 7 years?
I think 7 years is a really good horizon. The reason I'm pausing is because the things that have happened in the last few years disobey conventional thinking, right? Where it used to be, okay, there was a drought. We're going to expect droughts. We're going to expect wars. But then the manipulation of the market by, political players has changed things around, I think. I mean, this is the pandemic definitely switched things around. So that isn't something in the last, in the historic, 30, 40 years of the 7-year cycles that we've seen. I know that it was, similar in the 20s, that, there was a pandemic there and how it reacted to it. But I think that that's generally safe, and just know, yeah, there's going to be ups and downs. And I definitely fall into it too sometimes where I'm like, oh gosh, this is really bad. Or when the pandemic hit, I was thinking, okay, we're bottoming out. Maybe I should sell or I should buy. And then, or it's the top of the market. I've heard in China, things are happening. I think we're going to crash. Should I sell? And it's like, just stay the course. And I think that's the best advice I've been given too, is what you're saying is stay the course, and that's for your long-term investments, of course. And you have more wisdom too, right? So you understand more about. Right. Yeah. Right. This.
I panicked and I just don't stay long. I wish I didn't. Now
Yeah. Right. But just aware.
As I said, I remember the only thing that I would say different from other is that's what I do. I'm individual.
Sure. And that's all right. And that's what if you know those stocks, that's definitely makes total sense. And that's what I said. If you know those stocks and that is what you're comfortable with, absolutely. For me, I barely had time to like look around nowadays, but do I have individual stocks? I do, because a few years ago I had the time, so I, was researching, and I still feel comfortable with those. There's been a few that I've gotten rid of because I'm like, I'm not following that industry anymore. So, but yeah. Mm-hmm.
My friend is, so, I've gotten them into one more business. I've done some markets. Get them involved.
Oh, that's
They are
great.
not-
Mm-hmm.
My granddaughter, she loves the Facebook. Now she bought them.
Oh, what the Facebook stock is doing? Okay. Right. And for folks online, we're talking about gifts, stocks as gifts too. And that's, yeah. And your kiddo, as soon as they start making money, they can have a Roth, right? And contribute to that Roth account too. Fantastic. Yeah. Mm-hmm. Does anybody else have like a goal that they're thinking about, or just other things in the market, or they wanted to chat about?
I'm ready to take the money.
Mm-hmm.
But this is get our comfort.
Yeah. And when I honestly, I grew up on food stamps and everything. I didn't learn, it was kind of, drink from the fire hose when as a 30-something-year-old. And we were married at the time, and we had small accounts. And I said to my husband, I've been reading everything I can about this. This is really, I want for Christmas $200 that I'm going to mess around in the stock market with. I might lose it all, but it's my gift to myself. And I learned that. So I tried a little day trading. No, that wasn't my risk tolerance, buying and selling and watching that go up and down. And in the end, I figured it out. I loved it so much that I got my master's in it because it was just a passion for me. And, I saw what I wish I would have taught my mom, when she was younger, things that I would, teach other women that I was around, is how, and watching that grow, and the flexibility and the freedom that I get with watching that grow, has been so empowering, and to teach the kids too, right? Of course. No. Oh yeah.
My money went right with it. You don't sit there and beat yourself up every time. I lost that money. Okay, here's a little back. Then you try something.
That's it. Right.
I was so lucky. And I worked in the military part of it. And they had lots of stuff. And I would sleep in the back.
Mm-hmm. Yeah. And yeah, right. Right. Any kind of those educational things, or if you want to go through Fidelity or Vanguard, call their customer service and ask them questions. They're not trying to swindle you or anything. So.
Not risky, but to do more with the money than their father and I did. So if I was to go home and say to my oldest daughter, hey, you need to call, so you just said Vanguard, and she needs to educate herself, obviously.
Right.
But I want her to learn more that she knows that she can do things with money that's just sitting.
Yeah, I would honestly start with these books, with Simple Path to Wealth, and the podcasts out there are fantastic. A lot of people like financial planners or financial advisors. That's fine. Just make sure you get one that's fee-based and not commission-based. Sometimes they'll say, oh, it's just 1%. Well, that can really add up. I want to know exactly what I'm paying you and what I'm getting. And I don't want them just to turn around and throw a simple stock at me that I probably could have invested. I was at the coffee shop. I was at what is the coffee lounge? That's the one that went, yeah. And I overheard a group of 10 women, probably in their 30s, and they were just talking to each other about investments and really asking very simple questions, but being kind to one another. And I was like, I almost got a little teary because I was like, this is what we need. No offense to the men or online, but like, this is what we need. We need to be talking about these things and talking about how to grow our wealth and not